What's going on, guys? It's Kyle. Welcome to the Stock Goat YouTube channel. In today's video, we're going to be covering the SoFi stock. Today is the fireside chat with Anthony Noto, CEO, and also the analyst from Bank of America that gave SoFi the downgrade. So this fireside chat is going to start in 1 minute. I'm literally going to be filming this, on a YouTube video. We'll do a little bit of, updates at the end of the video just to see what I think about, what the analyst was saying and stuff like that. Also what Anthony Noto is saying. So this will be recorded for anybody, looking for the fireside chat and upload it on YouTube. And only if you enjoy this video, be sure to subscribe to the channel. Don't forget to drop a comment. I'm going to be commenting back to as many people as I possibly can. And be sure to smash the like button. Let's try and get this video over 1,000 likes. Alright guys, the video is starting now at 12:45 p.m. So let's hear what they have to say.
You're all to our annual Electronic Payment Symposium. We're excited to be joined for this session by Anthony Noto, the CEO of SoFi Technologies. Anthony, welcome to the conference and thank you for joining us again this year.
Oh, it's my pleasure. Thank you for having me.
Great. Why don't we just get started? There's a lot of announcements out of SoFi this morning also. And one thing I was curious on, SoFi has a lot of areas to invest. As I said, we've seen a couple of announcements this morning. And one thing that we were wondering about is just as CEO, where are you spending most of your time? What are the priorities when it comes to investment dollars, just among the wide array of places you could be spending them?
Yeah, so I put it into three big buckets. One is building the company, and that's everything from our strategy, setting the priorities for the year, our objectives and key results, and against that backdrop, allocating our resources to our most important priorities, making sure that we're executing against those priorities and holding people accountable. So that's one big bucket. The second is making sure that we have the right people in the right positions and they have the resources to accomplish what they need to accomplish. And that involves everything from recruiting to providing leadership to different teams, and giving them feedback along the way, as well as helping them eliminate blockers. So we want to have the right people in the right jobs and ensure they have the right resources, and we're helping get things out of their way. And the third bucket is more of an external perspective, which is building relationships with investors, building relationships with partners, and continuing to be a leader within the investment community, as well as the financial technology industry. So two buckets are internally focused and one externally. People often ask, how do we think about allocation of capital and priorities? And at the highest level as CEO, it's really my responsibility to allocate resources, get access to resources, and manage risk. And so that lens gets applied to all three buckets. And we look at each business on its own and make sure that business can become best of breed from a consumer value proposition standpoint, but also best of breed from an economic standpoint, based on unit economics or account economics. If we can build the best of breed product that builds the best trust with people and at the best economics, then we're going to have much greater scale, much greater operating leverage, greater variable profit, and that will allow us to reinvest at an even faster rate. And so we look at each one of the businesses on a standalone basis to allocate to drive the best returns for that business, and then think about how do we leverage the businesses together so they're more valuable together.
Great. So maybe let's start, diving into some of the segments a little bit. Maybe just starting with the Technicis acquisition. Firstly, congratulations on closing it so quickly. And maybe you can just give us a broad overview of what Technicis does. What are the capabilities it adds for SoFi, and what can you do now that it's part of SoFi when you combine it with Galileo that you maybe couldn't do before?
Sure. I think it's important to understand how we think about the long-term vision of the company and how Technicis plays into that, because one piece of the broader vision. And so our mission is to help people achieve financial independence so they can realize their ambitions. That's different for every person, but essentially means helping people get to the point that they have enough money to do what they want. In order to do that, we believe we have to be there for every one of the major financial decisions in their lives and all the days in between. And in essence, to do that, we have to be a one-stop shop across borrowing, saving, investing, protecting, and spending. And we want our products in each one of those areas to be, as I mentioned, best of breed. How do we define best of breed? We measure with NPS scores. We try to differentiate on a daily basis through constant iteration across fast selection, content, and convenience. And we're looking to hone the products so that they are, in fact, far superior to any other product on those different variables, and then also adding more value as they work better together. In order to get to that point of superiority by product, we believe we have to be vertically integrated. We believe we can innovate faster if we're vertically integrated. We could have lower cost if we're vertically integrated. And it's just that constant benefit being used over and over again. Our lending business was built from the ground up, from metal to glass, and we saw how fast we could innovate there. We have superior unit economics there. We have products other people don't even have, APIs to allow partners to build their applications in a seamless way and really in a turnkey fashion. As our partners at Galileo begin to think about more products, they need more products and services. But guess what? The products and services that people that partner with Galileo need are the same products and services that SoFi needs. And so as a company, we currently have 4 products that all run on 4 different core technologies. Checking and savings runs on a core technology from a partner. It's called Profile. Our invest product runs on a different core with a different partner, and our credit card runs on a different core with a different partner. We knew over time for us to get to the next level of best of breed product, the next level of personalization and innovation, next level of real-time decisioning, we would need to have one unified core. And so we're in the marketplace looking for one unified core and debating whether to partner with somebody or build it ourselves, and less functionality, and even more so now that we own Technicis. So we've been able to meet the needs of all of our partners and maintain them, in addition to growing by 44 new partners. And the key for us is making sure that we build that value from them. And now with Technicis and Galileo together, we think it's an unmatched service. We think it will operate at the lowest cost for our partners. That will be really hard for others to match because we have so many different economic pieces. And we'll innovate faster than anyone else, and also enable services that are very personalized and in real time in nature.
Great. That's really helpful. Thank you. Maybe switching gears to the bank charter. Obviously, you received it earlier this year. Just give us an update on how that integration is going. Where are you in terms of starting to get loans issued through the bank and in terms of just generating deposits?
Yeah, the team has done a great job since we got the final approval. We had to basically close down SoFi Money and stand up SoFi Invest. We had to transition over all of the accounts from SoFi Money we had to stand down SoFi Money and stand up SoFi Checking and Savings. And that includes having to transition people off of SoFi Money to SoFi Checking and Savings. It's a different technology. It's a different reporting process. It's a different marketing from a brand perspective and also value proposition perspective. So we worked really hard throughout the fall to be able to get approval in early December. So we would hit 2022 running on all cylinders. There's a variety of different factors that impact what's going on in Washington. If you've been paying attention, you'll see that the Fed chairman needed to be renominated. He then had to go through confirmation hearings. In addition to that, there were a number of other board members that were being nominated for new positions, and some new Federal Reserve Board members that were nominated, one of which withdrew. So there's a lot of moving parts throughout November, December, and January. I couldn't be more thankful that we received approval in January, but the fact of the matter is we lost that entire month from being able to market the new product. We then needed to go through a transition, and it really wasn't until end of February, beginning of March, that we were able to go generally available for the checking savings account. The team's done a phenomenal job in building that product and bringing it to market, and I'm really pleased with the progress the team has made, as well as a differentiated product that we have with consumers. And it's a really important top of the funnel driver for us. It gives us the central nervous system. When people do direct deposit, that's what we're trying to drive. And as we said in the last call, we're seeing nice pickup there. Once we have the direct deposit, the economics of that product work great. It's a viable standalone checking savings account product, but it also drives a lot of opportunity for cross-selling and leverage in what we call the financial services productivity loop. And we've seen really great progress there throughout the year, driving lower customer acquisition costs and really rapid growth in members and products per member in light of a more challenging backdrop for others on the cost side. So the bank charter is important for that checking savings account, but it also is an important part of our strategy to include funding our loans at lower cost. and the team has been moving the technology of our loan origination from our prior licenses with states into the bank and originating in the bank. And as Chris mentioned, we're on track to deliver that on the time that he laid out on the Q4 conference call in terms of loans being originated from the bank itself. And the funding costs there are much lower, in addition to the fact that we have one regulatory regime, not 50 different states.
Right. You mentioned Washington. Obviously, there's been a lot of noise around student loans. So let's just hit it head on. What are your expectations as to what's going to happen? One thing that we've been hearing is extension. One of the reasons arguing for an extension is that servicers might not even be ready to start processing payments here when it expires in May, so they might need one. What are you hearing? What's the latest on that beyond the tweets?
The industry, the servicers are ready for starting repayment, and they have been ready since the fall. The extension prior to the one in December, that September was supposed to be the end of student loan payments and the moratorium against those student loan payments. And President Biden administration extended the September date to the January 31st date to ensure that the servicers were prepared. We talk to the servicers all the time. They're 100% prepared to resume the payments of federal student loans on May 1. So that's not an issue at all. The economy is not an issue at all. It's very clear the administration is focused on potentially extending this for one reason and one reason only: midterm elections. It's 100% political. We have record inflation. We have strong economic growth. All the other aid programs tied to the pandemic that were instituted back in March of 2020 have ended. This is the last element that's left. And the progressives are putting a tremendous amount of pressure on the president and administration to stand by their campaign promises of giving forgiveness on student loans. And because they're not ready to do that, or they haven't come to the right structure to do it, they're going to kick the can down the road and consider other ways to keep the progressives off their back. One way is to extend the federal student loan payment moratorium. There's been a lot of noise out of Washington the last month. The president's chief of staff said that 2.5 weeks ago that next week the president would either extend the moratorium or announce restructuring, neither of which has happened. SoFi is going to be fine either way. We had record revenue in Q3. We had record revenue again in Q4. We did $1 billion of revenue in 2021 with our largest first business running at 50% capacity, and we had full year EBITDA of $30 million. So we're prepared for it either way. The good thing is we have a diversified business. That business has allowed us to hit those record numbers despite this student loan moratorium going on 2 years now. So we're prepared for it either way. We gave guidance to the street on what would happen per quarter if it was extended. So hopefully investors understand the economic impact as well. We're not going to slow down. The other businesses we have are driving great growth and contributing significantly. And we feel really comfortable that we benefit from a diversified business. Some businesses do well in a low rate environment. Some do well in a high rate environment. And we can continue to drive really strong top line growth and improve profitability without student loans if that unfolds.
Great. You mentioned the consumer is relatively strong. We've heard some, I should say, more comments about people worried about consumers, particularly at the low end, given gas prices and inflation. So maybe just talk to us a little bit about what you're seeing. Are you seeing any signs of weaknesses between different segments, between FICO scores, whether it's through your personal loan business, and I know you do mostly high end, but through your partnership with Pagaya, you probably do get to see some of what's going on even at the low end of the consumer spectrum there.
Yeah, demand for fixed rate term loans has been strong. We talked about our unsecured personal loan business benefiting from a higher rate environment as consumers look to refinance out of variable rate, high revolving debt into fixed rate term loan debt. And that business, has benefited. If you saw our, Q4 results, you could see the growth versus Q3. Our focus on high credit quality hasn't changed. SoFi underwrites 680 FICO scores and above. We actually underwrite to cash flow models, but we share with you what the FICO scores are that we have inherently target. We've had really great performance of our loans, both refinance student loans as well as personal loans throughout the uncertainty of the last 2 years since the pandemic started. And we continue to focus on that really high credit. Our FICO, actual average FICO scores are in the mid to high 70s across both products. We only approve about 30% of the applicants for unsecured personal loans. The other 70% we send to partners and monetize them through lead generation revenue, through Lantern, or through our partnership with Pagaya. What I'd say is demand for borrowing has remained high, just as we talked about in Q4, and our selection and quality has also remained high, and our delinquencies and performance have been consistent. And that information is publicly available through the different products that we securitize and as well as sell in whole loan form.
Sure. Just, you mentioned securitize there. We've seen some.
I'd have to say this guy's asking some really good questions to give investors good details. I mean, Technicis, straight to the bank charter, straight to student loans, and straight to credit quality. This guy is asking some really good questions for sure.
Some companies pull or maybe delay a securitization in the last few weeks. From what we've heard from our fixed income folks, demand for SoFi, particularly on the student loan side, product continues to be extremely high among the fixed income guys. But
we saw this happen in the pandemic as well. March of 2020, we weren't entirely certain what would happen on the demand side of buying our loans, either through securitizations or through whole loan sales. And I'm not sure people understand how broad-based the diversification of our distribution is. First and foremost, we're a bank. So we have the great luxury of funding off of our deposits and holding loans if we want to hold those loans. And philosophically, we want to maximize our return on each loan. So we have three ways to do that. One is we fund our loans through our low-cost deposits and we hold them. And our deposits are growing very nicely, and we have ample funding through deposits. We have $7 billion of warehouse facility. About half of that is committed. And there's more demand every day for others to want to give us warehouse facility because of the quality of our loans and the security behind it. And in addition to that, we sell our loans through whole loan sales, our asset-backed securities. The fact of the matter is our ABS sales have gone down meaningfully over the last 4 years and is now a minority of what we do. And we take advantage of that market if the pricing is right. Our preference is to sell in whole loans. We get great executions, really high, and it services regional banks and asset managers really well. They have very large deposit bases. They don't actually lend, and they need to get a return on the deposit bases, and we serve a great vehicle for them. So we're pretty diversified broadly from whole loan sales, asset-backed securities, as well as being able to hold the loans on our balance sheet when we fund via either deposits or through warehouse facilities. The demand for our loans is only increasing, it's not decreasing, and we benefit from being able to play each one of those sources of demand against the other.
Great. Maybe just turning quickly to home loans. I think you've talked in the past about getting to 1% market share over the next 2-3 years. Talk to us a little bit about the growth strategy to achieve that. Clearly, we're going to have a much more purchase-oriented market.
We have a very low market share. Our focus has been on fixing the back end capabilities so that we can really deliver on our value equation of fast selection, content, convenience. Historically, we've primarily just underwritten agency mortgages that are conforming, not jumbo. We also haven't been in the purchase market. So we've we closed that business down when I arrived in 2018. We were losing about $15,000 per loan. We relaunched it and re-architected it in late 2019 and have been growing the business very nicely, and it's a good contributor to our revenue and our profitability. Over 60% of our home loans are from existing members. So the first growth strategy is meeting the needs of our members. And what does that require? Well, it requires us having broad selection. And so we're expanding the selection into jumbo. We're expanding the selection into purchase loans. We obviously have to deliver on fast. We want to be the fastest place to approve a loan, fastest place to close a loan and fund that loan. And so we've been putting a lot of energy into that before we step on the gas pedal on the top of the funnel. We've largely driven most of our demand organically and from existing members as we build out the back-end capabilities of all those different products. We think the opportunity in front of us is enormous, even with a rising rate environment, just given the quantity of home loans, either purchased or refinancing, that our 3.7 million members already deliver. So we're really excited about the opportunity to broaden that selection. And as we broaden that selection, we'll be able to start to market much more aggressively than we have up until this point. But it's 100% market share, gain for us.
Great. We only have a couple of minutes left, but I did want to hit this last one really quickly. The stock has seen some weakness recently. Not surprising, in the context of the larger market concerns around student loan extensions. For whatever reasons they actually are doing them. Still a slight negative, at least for this year. You personally, however, have been buying shares almost every day. It feels like I see a new Form 4 from you. So it's quite, refreshing, a little different to see management actually doing that, and certainly a vote of confidence in the stock. Take a minute to tell investors 2 or 3 things that you think are probably underappreciated about SoFi and in the stock.
Yeah, what I'd say is my personal decisions to buy SoFi stock are really driven by one thing, and that's a long-term orientation on the company. I want to help this company become one of the top 10 financial institutions in the United States and one of the most admired brands in the world, and a top 15 technology company. And so if investors see me buying stock, it's because I believe in that long-term opportunity and vision of getting there. I think we have a position in the marketplace that's unmatched by anyone else, and will be incredibly hard for anyone else, including big legacy banks, to match. It took a lot for us to build it. It takes a lot of competencies. It takes a certain type of leadership and a mentality. And I think it's really hard for others to replicate, especially in an environment that's increasingly going to be challenging from an investing standpoint. And my desire to invest is really focused on the long term and the flexibility I have with my capital to make those investments. But no one should look into those decisions that I'm making as the current performance of the company or anything else. We obviously have a duty to disclose material, non-public information broadly, and my purchases of stocks are not tied to that. It's tied to the long-term orientation I have and the flexibility I have with the liquidity I have.
Great. Thank you so much. I think we're pretty much out of time with that, but thank you again for joining us. Really appreciate it.
Yeah, my pleasure, and thank you for having us, and we appreciate the interest and support. Thank you.
Great. Thank you.
All right, guys, pretty good fireside chat. You just need to realize this guy that was interviewing Anthony Noto, take a look at this. You could see here this analyst, Mihar B, had a $17 price target at one point. This was literally February 11th, and then if you go over to his tip ranks, you can see he downgraded the stock from $17 to $14. So that was 19 days ago. So a quick downgrade, and I believe the downgrade had to do with like student loans, like you said. He was saving that for last. It's not really a big hit. It's like a 10% revenue deduction or something like that. But as you can see, they used it as a big reason to do a pretty big downgrade, and that's the same thing that Morgan Stanley did with a $10 price target. And there is a lot of things going on today. And you can see today the stock is not really doing anything, on a big green day in the market. NASDAQ up 1.6%. SoFi is only up 1.6% as well. So the same as the NASDAQ. And you can see if you go over to Twitter, you have Elizabeth Warren. The student loan payment pause has provided immediate relief to millions of Americans. But now private student loan companies like SoFi are lobbying behind closed doors to end the pause so they can boost their profits. It's shameless and wrong. Guys, what I want you to do at the end of this video, go read these comments, because I read through the comments. You wouldn't believe how many people are against what she's saying. I mean, this post only has, 300 retweets, guys. She's got over 7 million followers. So a lot of people, if you read these comments, are not really agreeing with what she has to say. So I believe this is a big reason why SoFi is getting hit. Just another short opportunity. Big whales see these massive politicians, dropping comments like this on Twitter. All right, guys, to sum up the video, everything looks very strong for SoFi, of course. The bank charter is about to be in full effect. Deposits are growing. Consumer is still strong. It just looks like the one negative catalyst really hammering the stock is just those student loans with Biden, the extension, the midterm elections. That seems to be why the SoFi stock is not taking off like a lot of these other fintechs like Square, also Affirm, Upstart. I believe that's the big reason that's holding this stock down, is because shorts are really taking advantage of that student loan, confusion. So we just have to get through this eventually. And if there is another extension, we just have to get through it. We have a wide diversification of other revenue streams. Once again, if you enjoyed this video, be sure to subscribe to the channel. Don't forget to drop a comment. I'm going to be commenting back to as many people as I possibly can. Be sure to smash the like button. Once again, my name's Kyle. Hope you have a great day.